Welcome back. Today we will learn about deduction and reduction, the leveraging expenses and donation. Hey, let's chat about how to turn our everyday spending and charitable giving into a legal tax shelter that keep more cash in our pockets. What are deduction and reductions? Think of tax deduction as a golden discount code for your income. The government lets you subtract certain actual expense from your total earning before they calculate your tax bill. Itemized deductions, writing down actual out-of-pocket expenses like a medical bill or local tax if they beat the standard flat rates. Tax reduction credit. A credit a direct $4 discount off your final tax bill, which is even more powerful than a deduction. Charitable donation. Money or items given to registered non-profit that the IRS reward you for sharing. Deduction formulas and writing of actual expenses. Taxable income. The gross income minus total allowed deduction. The smaller number you actually get taxed on. Charitable gift. Cash gifts. Less than 60% of your adjusted incomes. Generosity is rewarded but capped at the limit. Medical of out pocket. Qualifying expenses minus 7.5% multiplied by our adjusted incomes. Only high unexpected medical costs pass this bar. Net tax out. Taxable income multiplied by bracket rates. Minus tax credit. Credit directly wipe away what you owe at the end. Why track actual expense? Many people blindly take the standard deduction every year because it is easy. But if you own a home, had high medical bills, or gave generously to charity, you might be leaving thousands of dollars on a table by not itemizing it. Without keeping receipts organized throughout the years, itemizing becomes a stressful losing battle in April. Theoretical calculation, deduction shifts. Let's look at how to tracking actual expenses. Change your taxable baselines. Compare it to just taking a standard deductions. If you get a gross annual 90,000, mortgage 12,000, charitable case and donation 4,000, stat and local tax paid is 5,000, total estimated expenses 21,000. The standard path is the income minus your estimated expenses 15,000 flat deduction. So 75,000 is taxed. The estimated path. With the estimated path you had 21,000 actual expenses. So 69,000 taxes. The taxable difference. You protect an extra 6,000 from being taxed at all. Real cash saved. Saved roughly 1,000 320 in a cash inside a 22% tax bracket. Visualizing where your deductions lives. Interpreting the expense breakdowns. In this scenario, house expenses, mortgage interests make up the biggest slice of your deduction pool at 57%, followed by local tax at 24% and charity at 19%. This balance shows exactly how homeownership and giving work together to drop you into a lower tax tier. Knowing which bucket move the needle must help you plan your financial goal for next years. Real life scenarios. The generous givers. Meet your friend Marcus. He make a comfortable living and donate 5,000 to a local animal shelter and clean waters project. He also paid heavy mortgage interest on his town home this year. By grouping his charitable donation into the same years, he had high mortgage expenses. He easily cruised past the standard deduction threshold. His kindness ended up saving him an extra 1,100 on his tax bill. The good deed 5,000 fully documented receipt from registering 51501 C3 Charity, tax reward 1,100 direct pocket saving generated by lowering his taxable income. Donating smart, beyond just cash. Maximize your giving impact. Donating cash is great, but the tax code offers brilliant workaround for no-cash giving. You can unlock massive reduction by thinking outside the checkbook. Appreciated stock. Donate stock that went up in value to avoid paying capital gain tax entirely. Household goods, dropping off old furniture or gloves, count as a deduction based on fair market values. Donor advice fund. Park a large chunk of money in a giving fund today for an immediate massive tax break. Let's take an expert advice. Bulletproofing deductions. Always get a writing receipt. Bunch your deductions. Track out pocket giving. And ladies, value your uses good fairly. Let's take a takeaway. Receipt and our receipts. Keep a digital folder for mortgage statement, medical bills, and donation receipts as they happen. Do the math early. Always compare your total actual expenses against the standard deduction baseline before filling. Give with intention. Align your giving goal with your highest income years to maximize both community impact and personal saving. Build wealth legacy. Using itemized expenses isn't a lawful. It is using the tax code exactly how the government designed it. When you master the art of tracking your actual expense and donation, you transform taxation from a dreaded bill into a powerful wealth build tools. Thank you very much to sitting with me, and I hope you very well. If you have a question, don't hesitate to write in the comment. and I advise you to subscribe in our channel to have a new video. Thank you very much. See you soon.